You are listening to CMQ Investing. My name is Chris Franco, and in this episode, you will learn how to avoid a catastrophic failure that most investors end up experiencing. That is the failure that comes when you do not pay attention to the impact that costs have on your overall returns. I'm going to read from Chapter 4 of Jack Bogle's Investing Classic, The Little Book of Common Sense Investing. It was published in 2007, but the lessons that you'll learn in this episode are timeless. If you apply them, you will do better as a result. Now, is that investment advice? Of course not. What it is a mathematical reality, one that most investors seemingly go through their entire lives, ignoring altogether. The chapter, by the way, is called How Most Investors Turn a Winning Game into a Loser's Game. So if you enjoyed the last episode, this will be right up your alley. But even if you didn't, this episode is still something that should be required listening. I'll say it, for the entire United States. Okay, on that note, let's get right to it. Let's explore in a bit more depth just why it is that investors as a group fail to earn the returns that our corporations generate through their dividends and earnings growth, which are ultimately reflected in the prices of their stocks. Why is this? Because investors as a group must earn precisely the market return before the costs of investing are deducted. When we subtract those costs, all those management fees, all of that portfolio turnover, all of those brokerage commissions, all of those sales loads, all of those advertising costs, all of those operating costs, the returns of investors as a group must and will and do fall short of the market return by an amount precisely equal to the aggregate amount of those costs. That is the simple, undeniable reality of investing. Let me say that again. That is the simple, undeniable reality of investing. In a market that returns 7% in a given year, we investors together earn a gross return of 7%. But after we pay our financial intermediaries, we pocket only what remains. There are then these two certainties. One, beating the market before costs is a zero-sum game. And two, beating the market after costs is a loser's game. The returns earned by investors in the aggregate inevitably fall well short of the returns that are realized in our financial markets. How much do these costs come to? For individual investors holding stocks directly, trading costs may average 1.5% or more per year. That cost is lower, maybe 1%, for those who trade infrequently, and much higher for investors who trade frequently. For example, 3% for investors who turn their portfolios over at a rate above 200% per year. In actively managed equity mutual funds, management fees and operating expenses, combined in what we call a fund's expense ratio, average about 1.3% per year, and about 0.8% when weighted by fund assets. Then add, say, another 0.5% in sales charges. Then there's the giant additional cost, one that's invisible. I'm referring to the hidden costs of portfolio turnover, which I estimate average a full 1% per year. Actively managed mutual funds are said to turn their portfolios over at a rate of about 80% per year, meaning, for example, that a $5 billion fund buys $2 billion worth of stocks every year and sells another $2 billion worth of stocks, a total of $4 billion. At that volume, brokerage commissions, bid-ask spreads, and market impact costs add a major layer of additional costs that are borne by fund investors, perhaps 0.5 to 1%. The result? Well, that all-in cost of equity fund ownership can come to as much as 2% to 3% per year. So yes, costs matter. The grim irony of investing, then, is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for. So if we pay nothing, we get everything. It's only common sense. A few years ago, when I was rereading Other People's Money by Louis D. Brandeis, first published in 1914, I came across a wonderful passage that illustrates this simple lesson. Brandeis, later to become one of the most influential jurists in the history of the U.S. Supreme Court, railed against the oligarchs who a century ago controlled investment America and corporate America alike. Brandeis described their self-serving financial management and their interlocking interests as trampling with impunity on laws human and divine, obsessed with the delusion that 2 + 2 make 5. He predicted, accurately as it turned out, that the widespread speculation of that era would collapse, a victim of the relentless rules of humble arithmetic. He then added this unattributed writing. Remember, O stranger, arithmetic is the first of the sciences and the mother of safety. Brandeis's words hit me like the proverbial ton of bricks. Why? Because the relentless rules of the arithmetic of investing are so obvious. It's been said by my detractors that all I have going for me is the uncanny ability to recognize the obvious. The curious fact is that most investors seem to have difficulty recognizing what lies in plain sight right before their eyes. Or, perhaps even more pervasively, they refuse to recognize the reality because it flies in the face of their deep-seated beliefs, biases, overconfidence, and uncritical acceptance of the way the financial markets have worked, seemingly forever. What's more, it is hardly in the interest of financial intermediaries to encourage their investors or clients to recognize the obvious reality. Indeed, the self-interest of the leaders of our financial system almost compels them to ignore these relentless rules. Paraphrasing Upton Sinclair, it's amazing how difficult it is for a man to understand something if he's paid a small fortune not to understand it. Our system of financial intermediation has created enormous fortunes for those who manage other people's money. Their self-interest will not soon change. But as an investor, you must look after your self-interest. Only by facing the obvious realities of investing can an intelligent investor succeed. How much do the costs of financial intermediation matter? Hugely. I can hear Jack Bogle saying that hugely. In fact, the high costs of equity funds have played a determinative role in explaining why fund managers have lagged the returns of the stock market so consistently for so long. When you think about it, how could it be otherwise? By and large, these managers are smart, well-educated, experienced, knowledgeable, and honest. But they are competing with one another. When one buys a stock, another sells it. There is no net gain to fund shareholders as a group. In fact, they incur a loss equal to the transaction costs they pay to those helpers that Warren Buffett warned us about in Chapter 1. Investors pay far too little attention to the costs of investing. Let me say that again in case you weren't listening. Investors pay far too little attention to the costs of investing. It's especially easy to underrate their importance under today's three conditions. When stock market returns have been high, when investors focus on short-term returns, ignoring the truly confiscatory impact of costs over an investment lifetime, and when so many costs are hidden from view, portfolio transaction costs, the largely unrecognized impact of front-end sales changes, and taxes incurred on fund distributions from capital gains, often realized unnecessarily. Perhaps an example will help. Let's assume that the stock market generates a total return averaging 7% per year over a half century. Yes, that may seem like a long time, but an investment lifetime is now actually even longer than that. 65 or 70 years for an investor who goes to work at age 22, begins to invest immediately and works until, say, age 65, and then continues to invest over an actuarial life expectancy of 20 or more years thereafter. Now let's assume that the average mutual fund operated at a cost of at least an assumed 2% per year. Result? A net annual return of just 5% for the average fund. Based on these assumptions, let's look at the returns earned on $10,000 over 50 years. Assuming a nominal annual return of 7%, the simple investment in the stock market grows to $294,600. Why? The magic of compounding returns over an investment lifetime. Now, how does the investor who achieves a 5% return do? By the end of the 50-year period, the value accumulated in the fund totals just $114,700, an astounding shortfall of nearly $180,000 to the cumulative return earned in the market itself. Why? The tyranny of compounding costs over that lifetime. In the investment field, time doesn't heal all wounds. It makes them worse. Where returns are concerned, time is your friend. But where costs are concerned, time is your enemy. The point is powerfully illustrated when we consider how much of the value of the $10,000 investment is eroded with each passing year. By the end of the 50-year investment period, costs have consumed 61% of the potential accumulation available simply by holding the market portfolio, leaving only 39% for the investor. In this example, the investor who put up 100% of the capital and assumed 100% of the risk earned less than 40% of the potential market return. Our system of financial intermediation, which put up 0% of the capital and assumed 0% of the risk, essentially confiscated 60% of that return. Our system of financial intermediation, which put up 0% of the capital and assumed 0% of the risk, essentially confiscated 60% of that return. I repeat, what you see in this example, and please don't ever forget it, is that over the long term, the miracle of compounding returns has been overwhelmed by the tyranny of compounding costs. Add that mathematical certainty to the relentless rules of humble arithmetic described earlier. Simply put, our fund managers, sitting at the top of the investment food chain, have confiscated an excessive share of the returns delivered by our financial markets. Fund investors, inevitably at the bottom of the food chain, have been left with a shockingly small share. Investors need not have incurred that loss, for they could have easily invested in a simple, very low-cost index fund tracking the S&P 500. Okay, the final stretch here. In short, the humble arithmetic of investing, the logical, inevitable, and unyielding penalty assessed by investment costs, has devastated the returns earned by mutual fund investors. Using Justice Brandeis's formulation, our mutual fund marketers seem obsessed with the delusion that investors capture 100% of the stock market's return, and are foisting that delusion on investors. When our fund marketers cite the stock market's historical annual return of 9.5% since 1900 and ignore fund expenses of 2% and inflation of 3%, they suggest that investors can expect a real after-cost return of 9.5%. Well, to state the obvious, they shouldn't. You need only add and subtract for yourself. The truth is that the real return of investors equals, you guessed it, only 4.5%. Unless the fund industry gives its investors a fair shake and improves the net return that it delivers to fund shareholders, it will falter and finally fail, a victim of the relentless rules of humble arithmetic. Costs make the difference between investment success and investment failure. So sharpen your pencils, do your own arithmetic. Realize that you are not consigned to playing the hyperactive management game that is played by the overwhelmingly majority of individual investors and mutual fund owners alike. The low-cost index fund is there to guarantee that you will earn your fair share of whatever returns, positive or negative, that our businesses earn and their stock prices and dividends deliver. Thank you so much for listening to this episode. If you haven't already subscribed or followed, you can do that on Spotify or Apple Podcasts. It's totally free. It's really important that you do that because it sends a signal to both of those platforms that CMQ investing is something that more people should know about. I also want to say, if you are unfamiliar, you can follow Charlie Munger Quotes or Warren Buffett videos on Instagram. Those are my accounts. I'm trying to do the same thing I do with this podcast, and that is spread really valuable investing wisdom that you can use and use to your advantage. For CMQ Investing, my name is Chris Franco. We'll talk soon. Later.